Moving on, China has cut its holdings of U.S. Treasury securities to $633 billion in the month of June. That's down nearly $26 billion from May. And that is the lowest level since September 2008. That's nearly 18 years ago. Now, this move is part of a broader, gradual effort by Beijing to diversify its foreign exchange reserves and reduce exposure to U.S. assets amid geopolitical tensions and uncertainty over U.S. economic policy. China has slipped to the third largest foreign holder of U.S. treasuries behind Japan and the UK. China was not alone in reducing its treasury holdings. Japan, which is the largest foreign holder, cut its stockpile by $26.4 billion to $1.12 trillion, while the UK reduced its holdings to nearly $940 billion. So overall, foreign holdings of U.S. treasuries fell by $72.1 billion in June to $9.3 trillion. That's following declines in the 3 of the past 4 months. At the same time, U.S. government bonds have faced selling pressure, with investors concerned about large fiscal deficits, heavy debt issuance, and also persistent inflation. The weaker foreign demand comes as U.S. Treasury yields climb sharply. The 30-year yield rose to its highest level since June 2007. Falling bond prices, they've pushed yields higher, and markets are demanding greater returns amid concerns over U.S. borrowings that need and also fiscal sustainability. China, meanwhile, has been steadily increasing its gold reserves as it reduced its treasury exposure. The People's Bank of China added gold for the 21st consecutive month in July, taking its holdings to over 76 million troy ounces. So what does falling foreign demand for U.S. debt mean for America? Now, if countries like China sell treasuries, demand for U.S. bonds can weaken, pushing bond prices down and yields higher. Higher yields mean borrowing costs for the U.S. government can eventually raise borrowing costs across the economy. So for the dollar, the impact depends on what happens to the money after the bonds are sold. If dollars are converted into other currencies or gold, demand for the dollar can weaken. But if the money stays in dollar assets, the impact on the currency can be limited. So fewer foreign treasury holdings can put pressure on U.S. borrowing costs, but it does not automatically mean a sharp fall in the dollar. Interestingly, U.S. dollar has fallen to over 2-month low, reigniting debate around de-dollarization.